Thank you very much for joining us. My name is April Dorey from the Heart Wealth Management Group of Raymond James. And here with me today is my business partner.
Hi, I'm Pam Katunar. I've been an investment advisor for over 15 years, and I'm delighted to be part of a large team that has a blend of youth and energy and experience. I'm very passionate about helping our clients through the various stages of their life, and I specialize in all of the complexities of retirement. I've had extensive personal experience, and our clients benefit from this as a result. I'm a strong believer in financial education, and I hope you will find this session and our future ones from our team valuable. Now back to April.
Thanks, Pam. Today with us is Uriah Kane, who's our estate planning advisor. He works out of our Kelowna branch and with Canadians, mostly in the west coast of Canada. And on our team, for those of you who don't know me, I've been in the industry since the late 90s. And we have built up one of the largest women-led financial advisory teams in the country. We specialize in cross-border planning and helping people with their complex situations. And so that's why when Pam suggested getting Uriah in front of you to talk about some advanced corporate planning strategies, I was really excited to share this information with you. And now, so you know, this is just a teaser, a little bit of information to get you thinking. There's been a heck of a lot of changes over the last few years, which Uriah will get more into, but we hope that you find this information valuable and timely. And now on to you, Uriah.
Thank you, ladies. I appreciate you having me today. April and Pam, thank you. Look forward to spending a few minutes with you and your network today. Obviously, the goal this morning is to just spend a little bit of time talking strategy and what are some of the ideas and concepts that business owners and their accountants have available to them to address a whole myriad of new tax changes that took effect at the beginning of 2019. I do have a slide deck prepared here, and so what I'll do is my best to make sure that we've got this queued up properly. So ladies, if for whatever reason you're not seeing this, let me know, but assuming that that you can see that there, is that working?
Yep, perfect.
Okay. So I'm just going to pull this up here on my end. As I roll through that second slide, are you seeing that?
First slide.
Okay. Again, just bear with me because on my end, there we go. Okay. Well, it's a pleasure to be with you, and thanks for spending or giving me a chance to share a couple of thoughts with you today. My name is Uriah Kane, and I work as one of the tax and estate planning specialists here at Raymond James. I'm based out of the Okanagan, but I owe a lot to this technology because it allows me to enjoy the lifestyle that the Okanagan offers, but work across the province. So it's great to be with you today. Really, just in the interest of time, I'll get kind of right into what we wanted to kind of share today, which was really just this idea of using insurance as an asset class. I have a whole series of presentations that I do, with accounting firms and advisory offices here in the province that I've titled Advanced Tax and Estate Planning Series for Small Business Owners and Incorporated Professionals. And based on a whole series of tax changes that were introduced starting in January 2019, I start this section of my presentation off just referring to the fact that there was a whole range of different changes that were targeting Canadian-controlled private corporations. The date that still stands out in my mind, and many of my colleagues across the industry, goes back to July 2017 when the Department of Finance, under the direction of the Liberal government in Ottawa, rolled out a whole series of very punitive proposals targeting private corporations. And at that time, there was a 75-day consultation period that allowed feedback. And they got 21,000 submissions in of people that had all sorts of different opinions and ideas on what was being proposed. But in the end, what ended up happening was a series of tax changes that we'll talk a little bit about today. And the reason I wanted to start with that as the foundation for the conversation was really just to kind of stress the fact that there are some tax issues that have always faced business owners who are accumulating wealth inside their private corporations. And this latest round of tax changes really just kind of magnifies that. The first slide that I wanted to start with this morning was really just talking about what is the Department of Finance's rationale? Like, why did they want to look at this? And, I've included a couple of statistics here going back a couple of years ago that really just kind of share some insight into what the trend has been around accumulating assets inside of private corporations, and numbers going back to between 2002 and 2015 suggest that there's been this very, very large accumulation of wealth taking place inside private companies. And back to that July 2017 correspondence coming from the Department of Finance, and I'll quote them here. They said, "Preferred tax rates for corporations were never intended to facilitate passive wealth accumulation, such as through passive investments," end quote. And really at this point, the issue that the government has, or at least they've gone on record to suggest is an issue for them, is this idea that a business owner can be taxed up to the first $500,000 that they earn in their business at depending on what province you're in, 12% corporate tax rates. That's pretty good, very low. And the issue that they have argued is that based on our current tax landscape, there's a tax deferral advantage that these business owners have. So imagine earning $1 in your business, you're taxed 12 cents on it, you're left with 88 cents. To go out and invest that into a real estate empire or stock bond mutual fund portfolios, passive assets that are not directly tied to the business, and then allow them to accumulate, that was viewed as an unfair advantage to business owners over somebody who might be a salaried employee. Continuing on, this idea that somehow, if we're going to have to come up with a tax base focusing on, high net worth families across the province, across the country, was certainly kind of a policy initiative that the sitting government and the Department of Finance wanted to focus on. But what's interesting is you start looking at some of the data and getting into the numbers. I'm kind of a geek that way, I guess, and I'm always interested in those details. There's a number of different, third-party think tanks out there that have provided some interesting insight. The one that I've shared here really suggests that households earning over $100,000 a year in income, based on these statistics from 2014, suggest that that group of people represented 8.4% of the tax forms filled and submitted. But they also represented 51.8% of all the federal income tax that was being collected. So we've got this small group of people paying more than what some of us feel is their fair share in taxation, and yet despite that, there has been a very, very strategic and explicit approach at further tax reform to target wealthy Canadians, and clients that we meet with are entrepreneurs, small business owners, professionals like doctors and dentists and chiropractors, people who kind of fall into that category. So really, by the time the dust settled, what was proposed in 2017 was a huge, massive list of different things that they were looking at. But by the time submissions were submitted and polls were gathered and information was provided, the government kind of rolled out, a series of tempered tax reform changes. And two of them in particular here, I think I wanted to share today that really kind of hit to the heart of some of the issues that our clients and the people that I'm asked to advise are dealing with. The first one is many of your network will understand, for those who have an accounting background, is this idea of tax on split income rules. Up until 2019, there were some very broad interpretations of how a business owner could pay a spouse or a child who might be working in the business. All of that changed in January 2019 with a whole new regime of tax formulas to determine whether a spouse was eligible for dividends being paid out of the business. And so this is referred to as tax on split income rules. Very complex. I've worked with a number of different accounting firms who've done their best in a one-page spreadsheet to kind of follow the different arrows and lines to determine where and how these rules are applied. But at the end of the day, it's become more difficult for business owners to pay family members and spouses depending on their level of involvement in the business. And to be able to just randomly pay somebody a dividend, those days are over. We have to now spend quite a bit of time, justifying who is getting paid and how. And if we can't do that, then there's some high marginal tax rates that are triggered on that income that's being paid to a family member. There was a second thing here, and this is the one that I think is really the focal point of some of my comments today. What we refer to now is the adjusted aggregate investment income. And really, if I was to summarize this, what it entails is anybody who is generating passive investment income inside of their company, or affiliated companies to their operating company. It's very common for us to run into situations where a business owner has their operating structure and there's also a holding company. Traditionally, there's been the ability to move capital from operating company to holding company tax efficiently. And at the end of the day, whether that business owner's assets are accumulating in their operating company or their holding company, they're all considered to be one affiliated group. And what the government came out with was a series of rules that suggested any passive investment income that's being earned above $50,000 a year would trigger a clawback on what we call the small business deduction rate of like I said, depending on the province in question, we'll call it 12% roughly. So imagine a situation where, and I see this a lot with doctors as the profession at ground zero that's really been caught in the crosshairs of this whole tax reform. Many of these doctors don't have a practice that they can sell, and they build the province, so they're actively working, and they build the province for their hours and their time. That generates inside of their medical corp, and if they do have an affiliated holding company or something like that, they are on their own to be able to provide for their own retirement. So it's very common for us to see the building that many of them are running their little practice out of, they own. They're also, in some cases, charging rent to some of their colleagues. They're generating rental income. They're generating interest income, potentially realized capital gain, and dividend income off of their investment portfolio. And many of them are crossing over this threshold of $50,000 in passive income. The problem with that is that if they earn up to $150,000 on those passive investments, not directly tied to what they're doing their day-to-day operations with their medical practice, they will see a full clawback of that 12% tax rate, and they'll move into what's called the general rate, corporate rate at 26%. So these two changes are having a direct and immediate impact on some business owners out there. So what do we do about that? Those rules came into effect in January, and the second section that I wanted to talk about really just focuses on what are some of the cornerstone strategies that these business owners are being advised to consider in light of that new shift in the landscape from a tax planning standpoint.
Uriah, can I just ask you a quick question before you go on?
Please do, yeah.
In your experience in dealing with business owners, you specifically mentioned doctors. Are there other professions that you've really seen this kind of have a huge impact specifically on?
Yeah, great question. Thanks, Pam. At the end of the day, anybody who is accumulating wealth inside of a private company, or what we call a Canadian controlled private corporation, has the same issue.
Okay.
And that's really, I think, a good transition into the next slide. Thanks for that question.
Okay.
Whether you are, we've met with engineers, with chiropractors, with dentists, with business owners.
Okay.
All of the real estate corporations, like the developers and
correct. And all of these corporate structures, 50 years of corporate tax planning advice, regardless of what government was sitting in power in Ottawa. 50 to 60 years of corporate tax planning advice would suggest, or has suggested historically, pull out of the company what you need to feed your family, put food on the table, put gasoline in your tank. But anything that you've got left over as retained earnings, keep that inside of the corporation. It can be invested in a stock bond mutual fund portfolio. It can be invested in real estate. It can be reinvested back into the business, whatever that business might be. But retain the excess inside the corporation and let it grow. And so, I don't ever come to the defense of the CRA lightly or often, but the argument that they're making here is that if I have an after-tax corporate dollar of 88 cents that I can then go out and do something with, versus pulling that out either as a dividend or a salary, I'm left with 88 cents corporately versus maybe 60 or 62 cents personally. That is ground zero for this entire tax reform conversation that's taking place nationally.
Yeah, except they're forgetting the risks that the business owners take to get that 88 cents, and they're leaving that whole conversation off the table. I mean, so many of our clients, business owners, have had their wife helping, doing some things, and they structured their life around this.
Without question.
They don't get a pension. They don't get all those things that, the ones that are writing about this are complaining about. So this is very important information that you're sharing, Uriah. And thank you for trying to help preserve what these people have worked so hard for.
Yeah, no problem. I really appreciate kind of those comments, because at the end of the day, April, I think what was so offensive about certainly the proposals that were rolled out in July of 2017 was this idea that business owners and in many cases small business owners, families, right, who had been following the advice of their accountant for decades, all of a sudden we're being painted as tax cheats or somehow.
Yeah. That's so wrong.
Yeah, which really caught a lot of us in the industry a bit off guard. At the end of the day, I agree with you, and the feedback, the resounding feedback from all of the people that I've met with, most accountants and many of the business owners that we've interacted with, all feel the same thing and have voiced the same concern you did, which is, wow, I know that the Department of Finance came out with some, and they used specific case studies to build their argument back to July 2017 for those that followed this stuff, and they used kind of Jane business owner versus Joe employee, and they built an argument around why Jane business owner had this competitive advantage, but at no point in any of that correspondence or dialogue was there any onus put on the risks that business owner took to run her business.
Like right now, well, all these Jane business owners are out of luck because they've had to close and they don't have anything. They can't work from home when they're supposed to run their shop. It's just terrible.
Yeah, it's been disconcerting. And so, what I appreciate about what we did across the industry in the summer of 2017, because they gave us up until, the end of August, beginning of September to get some feedback into them, was this resounding argument that came out of it from industry. What was that? Is tax reform something worth considering? Many of us in the industry concede that the answer is probably yes. But at the same standpoint, if there is going to be reform, serious, corporate tax reform looked at, the approach that most of us across the industry are asking for is a similar approach that the government under Diefenbaker took in the mid to late 60s. It was called the Carter Commission, and there was a multi-year dialogue between industry and the Department of Finance on what would be the best approach. They came out with a whole myriad of different suggestions, some of which were implemented in 73 under Pierre Elliott Trudeau. He realized that was political suicide, so they repealed some of those changes for those of your viewers who might understand or be interested in the history. But my point is simply this: if tax reform is required, going out and spending the time with all of us in the trenches who deal with this on a daily basis to kind of collaborate on what the best approach is what we've been asking for. Not this manifesto that's rolled out in mid-July, which was kind of cheeky, right? Many of the accountants out there have worked very hard through tax season. It's not uncommon for them to take some time off through July or August, and so to have this stuff rolled out at that time was viewed as a little underhanded. So at the end of the day, we are where we are, and the point that I want to kind of make next as we move the conversation along is this idea that that business owner who has accumulated their wealth inside of their company, whether an opco or holdco or whatever that structure looks like, has two very specific tax issues that's lurking just underneath the surface, whether they know it or not. First is a tax on growth issue. And so I talked about how that 88 cents, left over in the company that might be invested, depending on where it's invested, under the current rules as they stand today, September 2020, they could see taxation as high as 50.67% if they're generating foreign dividend income. interest income, rental income. You know, even though it's 50% taxation, I'd rather have 88 cents working for me versus 60 cents personally, if that makes sense. But that tax on growth issue has always been there. But there's a second issue, and it's a tax on death issue. And I don't think enough people out there understand what the ramifications of that are. So, you know, with your permission, I'd like to maybe just take a minute or two to explain that. If business owner passes away with this big chunk of money sitting inside holding company, which over time has been repositioned as their retirement nest egg, back to my, you know, doctors as the profession I used as the example. If they were to pass away, what happens is the shares of that holding company have a value, and it's typically based on whatever the book value of the assets are. It could be real estate, could be, you know, a fourplex or a duplex, the building that they have their medical practice in, a stock bond mutual fund portfolio, whatever that stuff is as value. If it's grown in value, then so too of the shares that they hold in that holding company, and that's taxed on the business owner's terminal tax return personally. That's you know, tax trigger number one. Depending on the estate objectives, once that business owner is gone, if those assets need to be sold or liquidated, which happens all the time, that would trigger then a second layer of realized capital gains and taxation inside the corporate T2 tax return. And then if there were any surviving spouses, family members, business partners that then wanted to split whatever that financial legacy was, that would then need to be paid out as potentially as a taxable dividend, and that triggers multiple layers of taxation. That's a problem. And in the analysis that we do, we use some sophisticated, you know, financial planning software to try and figure out what that tax liability looks like, and then maybe come to the table with a couple of recommendations. But when it's explained that way, you know, Pam and April, does that make sense? Kind of this tax on growth, tax on death issue?
Yeah.
Yep.
Yes.
Yeah. So how do we address those two problems? That is the million-dollar question. And so this next slide really focuses on what are some of the strategies that are out there that either financial planners or accountants, and all of us are being asked these questions all the time right now. What can we do? Well, you know, I've got 5 summarized points here that I view as potential, you know, strategies for addressing that problem. Problem number one or point number one is, you know, if you don't have $50,000 worth of passive investment income that's being generated internally, then, you know, you don't need to worry about it yet. And that threshold, how and where they came up with that, the idea was if you have $1 million of investable assets earning 5%, that's what generates this $50,000 in passive investment. And that's kind of where the threshold started. Strategy number 2, consider max funding RSPs and TFSAs. This is, again, pretty common, right? If we're going to pull money out, Mr. Business Owner, it's not uncommon for them to be getting accounting advice or tax planning advice that suggests pull the money out. There's a taxable event, either as dividends or salary, T4, and we can offset that taxation event inside your personal tax return by making an RSP contribution. And so that's very common for us to run into situations where business owners have some RSPs on top of whatever wealth they've accumulated inside of their company. And to be honest with you, that's what the government, in my perspective, wants to see happen is pull the money out. It's fully taxed. You can create a bit of an offsetting tax deduction. But as both of you ladies know, you know, that the money that grows in an RSP, it grows tax deferred. But there is a reckoning that will likely come at some point in the future as that money is drawn out, you know, during their RIF years, you know, as late as 72 when it's fully taxable as income. Strategy number 3, consider setting up, you know, corporate class mutual funds. This is, you know, I see this across some practices where there is the ability to invest in some, you know, over the counter products that allow for some tax efficiency to defer a T3 or a T5 tax slip that might be issued from the investment company to that corporate T2 tax return. The last 2 points I want to focus on most, though, and point number 4 is individual pension plans, IPPs. And last but not least, life insurance is an asset class. IPPs, and I'll move on to the next slide because I have one that specifically targets that, is a strategy that kind of fell out of favor through the 90s and early 2000s, but has really kind of re-emerged as a concept worth considering in some cases. In its core, what it is that it's a defined benefit pension plan. My dad worked his whole career for the federal government. I grew up in Kingston and Ottawa. He was with Corrections Canada. And he retired with an EX1 level, you know, senior manager level pension. and never needed to worry about kind of his retirement years, knowing that at least he'd be able to fall back on that pension. Business owners and entrepreneurs and incorporated professionals have the ability to set up their own defined benefit pension structure. There are some costs associated with setting it up. There are some costs associated with reviewing the health of that pension, which falls under federal legislation. So there's actuarial services that are required at the very least every 3 years, and that comes at a cost. But the benefit of that strategy is the business owner can make a contribution into that IPP, and it becomes a fully tax deductible contribution from their corporation into the IPP. So we're seeing that in some cases. Where I see this really being a good strategy is somebody who might have $1 million, $1.2 million, $1.5 million, and the accountant and the business owner have decided that they want to unwind the corporation. We see that from time to time. Triggering this IPP structure or strategy might be one way to at least get some of the money out and trigger some tax deductions to the corporation. You're just deferring the taxation down the road, but it's at least a strategy worth considering.
Oh, they're excellent. And we have quite a few of them, Uriah, and love it. I mean, what you said about it's a cost to do the actuarial. I mean, the $3,000 or whatever it costs a year or every 3 years, it's deductible to your business, right? So it's all, they're great. And, you know, for higher income professionals, higher income professional corporations or business owners who are reliably earning a lot in their corporation, these are wonderful sort of supersize RSPs is what I like.
Exactly. Yeah, it's an RSP on steroids. You know, you're not dealing with kind of the income threshold maximums that you'll see on the personal side. And this is a strategy that you know, we're not only you know, recommending, but we've got some senior people inside of our, you know, private wealth management team out of Toronto that have some experience with this and are happy to kind of provide some assistance to accountants on kind of how to implement, monitor, and oversee this.
Great.
It's interesting that these used to be around quite a bit, and they kind of, like you said, fell out of favor, and now they're kind of back in the spotlight again. So it's a good reminder to people who might have kind of put this on the shelf in previous years to kind of dig it out again as another tool.
Yeah, exactly. So here's the thing about IPPs that you know, I stress at the bottom of this slide is really they have always from the very beginning they've been structured and designed as restrictive and illiquid, and that's by design. You know, in my dad's case, if he decides that he wants to take, you know, all of his children and their families on a big vacation and somehow wants to tap into his pension and draw out 25, 30, 50 grand, that really isn't an option for him. That pension is really designed as a consistent and you know, means for generating retirement cash flow. These business owners have the ability to set up something similar, but they are restrictive and illiquid by design. Based on legislation that was introduced through the Harper Conservatives, you know, these business owners can now at least income split that pension income between them and their spouses after age 65, which is kind of nice. And it's a strategy worth considering, but there are some limitations to it. The final strategy that I wanted to focus on for the rest of our time today is really the area that I have been asked inside the organization to focus on, which is this idea of corporate-owned life insurance, and there's some interesting and unique features to how this structure works. It's neither capital property nor a debt instrument, and it's governed by a very specific and special separate section of the Income Tax Act. Premiums that go into this structure that I'll be referring to for the rest of my time today, they're not deductible. And so, you know, the reason for that is because we want the death benefit, if and when that pays out in the future, to be tax-free. So I do run into the odd accounting firm where they're looking, or they have, you know, made a tax deduction to the premium payment going into the insurance. That's typically not what we're advising be done. What's interesting about the strategy is coverage protects the interests of the company, and it offers the ability to shelter, you know, from some of these tax rules I was talking about earlier, this taxation of passive investment income and capital that's left inside the company. Any money that is repositioned or capital into this strategy, you know, grows in a tax-exempt environment. And here's the point. Who would have thought that, you know, life insurance would provide the structure or the wrapper for an investment vehicle that would allow us to aggressively overfund it. And anything that went into that strategy that wasn't related to the insurance but went to investments could grow in a completely tax-exempt environment that would also allow the business owner to tax-free access and flexibility and liquidity to whatever that cash value is in the policy if they needed it down the road. It is really kind of a very unique feature that nothing else out there really provides us with. The last point I'll make here is that structured properly, funded properly, there is the ability that as we grow those assets and just reposition them from stock, bond, mutual fund portfolio that business owner might be holding on to, but repositioning some of their wealth into this structure, it can also be positioned as a potential pension style income stream down the road as well as they borrow against the cash value. The most important aspect of this strategy, the kingpin that holds it all together, is this capital dividend account. In many of the financial plans that I'm building and running, we're doing all sorts of future tax estate liability projections and net worth projections to the estate. And in many cases, what we're seeing are very successful business owners who did a great job in their careers amassing wealth, to the point now where their wealth is growing faster than they're spending it. And in those specific circumstances, once we're very, very certain that our projections are as accurate as possible, the argument is simply, hey, you're going to have more money than you'll ever spend. Why don't we just reposition some of it into this planning so that it can at least come out as tax efficiently as possible through something called the capital dividend account down the road. So with one strategy recommendation, we position the business owner to at least accumulate some of their wealth in a tax deferred environment. There are mechanisms for accessing that cash flow as tax efficiently if they needed it. But the lion's share of the planning really rests on this idea of what we call an estate bond, which is if you have money left over, let's just have it come out as tax efficiently as possible, because what this strategy does is it bypasses all of those tax issues, that double or triple taxation event I was talking about earlier. I've basically just kind of summarized here how it works. The corporation is the owner, the payer, the beneficiary. And based on how we structure these strategies, we can overfund it beyond just the cost of insurance to start accumulating wealth inside the contract. Post-budget 2018, accountants don't regularly kind of, float into the foray of advanced insurance planning, but, a number of the experts that I follow across the industry, if you have accountants listening to this after today, they will most certainly recognize, an accountant I follow closely in my network called Kim Moody, who runs a group out of Calgary that does very, very advanced planning, strategy planning, mentorship, and consulting for accountants. And he said here, quote, in order to avoid the application of the new grind down of the SBD, consideration should be given after receiving good investment and insurance planning advice to having the CCPC invest in a tax-exempt account of certain life insurance policies. And in parentheses here, he says, if there is an underlying need for life insurance to begin with, quote and unquote. Most of the analysis we're doing, we're figuring out what that tax liability is. And our argument is, hey, let's reposition some of the capital. Worst case scenario, it becomes estate planning. Best case scenario, structured properly, it might have become a tax-free savings account hybrid inside your corporation.
Raya, before you go to the next point, could we stay on the insurance part for a second? So yeah. What are the, because that's one area that a lot of people don't know about and we're all afraid to ask. So what's the maximum age people can buy insurance? And, let's say you have diabetes, are you still likely to get insurance? The business owners that we see are typically, that are starting to worry about these problems are 50 plus. Yeah, and so they may already have one or more medical things. And is there any strategy, let's say daddy business owner has a heart problem, he's probably not insurable is my guess. Would you make it joint with the wife, or is there ways around it? So can you stop here and talk about that for 2 seconds? For
sure. The caveat to this entire conversation today, to the entire foundation of the strategy planning I'm referring to today, rests on one caveat. The business owners that we're dealing with have to qualify medically to get this structure in place. at its core, we are opening up and submitting a life insurance application, and there is a medical underwriting review. And most of the work I'm doing, age group tends to be in the mid 50s to mid 60s, late 60s. We're doing more and more work with younger business owners now. We've done it for people even as late into their mid 70s, late 70s. But what happens is we have to qualify medically. So there's been a lot of scenarios. What I'll typically do to answer your question is we'll set it up commonly if there's a business owner and a spouse, we'll set up both of those spouses as a joint last to die policy paid on last death. What that does is it reduces the actuarial age that they use for their cost of insurance analysis. But we have to kind of qualify medically. That involves, having a nurse come out in many cases, providing a blood and urine sample. And we have run into situations where one or both, business owners and or the spouse were not eligible to qualify, or it was rated. Or we had one spouse who was approved and the other that was rated. We've seen all sorts of different scenarios. There's a series of different ways that we can kind of navigate those situations, but they have to qualify medically.
But that doesn't apply to the IPPs. So IPPs, there's nothing to do with medical.
Great point. With IPPs, an IPP is really just a repositioning of that wealth corporately to personally into an RSP type structure. Yeah.
It's also important in dealing with insurance too, for people to understand that when they're older and they're applying for insurance, they're not being compared to 20-year-olds. They're compared to, their age category in terms of the underwriting part of it as well. Would that be correct, Uriah?
That is correct. Yeah. And I've had clients in their 40s who were declined because of recent health history. And, we've just got a file that we're working on right now. Clients in his late 70s, and we've just gotten initial approval for him. And he's been compared against every other 79-year-old that's out there. Every situation is slightly different, but at its core, what we are setting up is an insurance contract as the outside layer or wrapper for this structure I keep referring to. And funded and structured properly, what we want to do is start aggressively overfunding what will be allowed in there. And there's a whole series of actuarial calculations and formulas that the insurance companies have to adhere to meet the tax guidelines that have been set out by the Department of Finance and the CRA. Our industry went through a major tax reform, at the end of 2016, but we feel that if this capital needs to accumulate somewhere, repositioning some of it, not all of it, into this type of a strategy, in many cases becomes a very, very applicable concept that positions these business owners to address both the tax on death and tax on growth problem that they have. And I always keep going back to that idea because, the argument that we make is, hey, don't take any advice. We've done a good job of determining what tax on growth and tax on death looks like. But, based on a reposition of some of your wealth, if we were to implement and layer into your overall holistic plan, this strategy, we can then start doing some comparative analysis. And in most cases, the business owners are much farther ahead as they're able to pull that money out of their corporation tax-free on death.
Just a couple comments too, just to add to that even in the pandemic, the insurance industry has still found a way to continue on with testing and going through applications and that, just to let everybody know that that's still a possibility. The other comment I wanted to ask you about was just, sometimes people have the perception that in this low rate environment, this might not be a strategy that works as well. I don't know if you wanted to make just a quick comment on that as well.
Yeah, great question. At the end of the day, what we're doing is we're repositioning a portion of the business owner's capital or wealth into this structure, and this insurance structure from an investment standpoint, that could be a whole separate conversation if we wanted to do another session together. But at the end of the day, we have the ability to over contribute into an insurance contract, and a portion of that over contribution goes into a portfolio. I'm a big proponent for Par Whole Life. There's a whole separate, product platform called Universal Life. Again, that's another conversation for another day. Most of the plans I'm setting up are participating whole life insurance, where that excess is invested into a basket that's predominantly bonds, mortgages, and real estate, with a small sleeve in common stocks, typically Canadian banks. And, in a low interest rate environment, You know, whether that business owner is holding their money inside GICs or bonds versus in the structure that I'm referring to, that low interest rate environment affects both equally. And we're just suggesting as a fixed income alternative to bonds, this becomes just an additional fund manager or management team that we could add into that business owner's overall portfolio to just manage some of the risk associated with the fixed income sleeve.
Agreed. Thank you.
Yeah, good point. Continuing on here, just have a couple of slides left. You know, a simple case study here. This I put together. This is an actual, you know, real case study from last year. You know, this was a business owner and who had been very successful. He was a dentist, and you know, his income, you know, his gross business income was about 600,000. Annual income was 385. You know, he had accumulated a net worth of about 8.2 million. And based on our analysis, he had an estate tax liability of about 1.5 million. What we ended up looking at was repositioning, you know, a portion of what he held inside of his private corporation into this strategy. And we looked at 100,000 a year of 10 pay, where we can pay it up early, aggressively overfund it for a period of time, and then kind of turn off the taps for what's expected for additional premiums. And what we assumed was a, you know, a 5.1 dividend scale interest rate. The company that we used in this case was Canada Life at the time. Canada Life, Sun Life, Manulife, Equitable Life, Empire Life. You know, there's quite a few carriers that offer, you know, a similar product in their product shelf. But at the end of the day, what we looked at was, what if we repositioned some of this money in, and then he borrowed against that policy during his retirement years, and what would that look like as a bond portfolio versus tax advantage insurance, I'll call it, strategy. And we were able to run a very detailed you know, tax analysis of those two apples to apples comparison scenarios. And I wanted to show you what this looked like. The only other point I'll make as I move to the last slide is, you know, we were assuming a bond portfolio of 85% with 50% equities as the comparison analysis. The reason I did that is because that is basically the framework and makeup of the participating account at Canada Life. And so in this case, what we ended up doing is we were able to kind of forecast, hey, 100,000 in over 10 years, what would that look like? These are corporate dollars. And then if he were to then borrow over 15 years between age 80 and 95, column 1 represented just him drawing down the investment. Column 2 represented this you know, this pension style income stream that I was referring to previously. And what the analysis showed us was that we were able to generate the same cash flow in both cases. What was interesting as we kind of started taking some of that forecasting out, because of the tax inefficiency of the bond portfolio versus the tax exempt status of this insurance policy structure I'm referring to, you know, out and assuming that life expectancy at 95, you know, what was left over after, you know, the loan was paid out using this cash value of the policy as collateral was, you know, just under $400,000 using bond portfolio versus $845,000 to the estate using insurance as just the TFSA hybrid vehicle for investing. Here's the only other point I want to make. Prior to 2010, that comparison was more than enough justification to consider the planning. There is, you know, almost double the money that's left over based on some of our metrics and assumptions here. But here's kind of the crowning piece, and this, not all the accountants I meet with understand this. Pam, in some of the meetings you and I have had, you know, where we've had these conversations with accountants, you know, this has been an eye-opener in all of the conversations we've had with them. But the point is that even though this business owner may have used insurance as a pension style income stream down the road, they were still able to completely maintain their CDA credit. And so to think that we were not only able to generate similar cash flow, if not double, but that there was still almost a $4 million CDA credit that would allow him to kind of pull out the lion's share of everything else that was not repositioned into this out of his corporation for estate planning is a massive benefit. Now, if there was no borrowing done, no pension planning or creative ways to generate cash flow down the road, you know, the benefit to the shareholder was 1.8 million with no, you know, high level advanced insurance planning versus almost 4 million. We were able to double this business owner's estate, having kind of just repositioned some of his wealth, which he may or may not have needed in the future. This is based on current tax, tax landscape, current tax rules. Things could change in the future. And really all that this was designed to show as a simple case study was that, money in can generate money out, and that as we compare, this strategy to bond portfolios, in most cases we're able to generate similar, if not more, cash flow. But it's that ability to maintain the CDA credit is a massive reason why we think this planning makes sense. I've got all sorts of case law on this. A number of the insurance carriers have entire volumes of commentary on the tax law that led to the rules around why this is the way it is these days. We're happy to share that information. So the only other thing I wanted to stress at the end is who's the ideal candidate. Anybody, whether they're in their mid-40s or mid-60s, if they are a business owner, corporately structured, accumulating assets inside of their corporations, we feel that this strategy is very, very viable as a means for just protecting wealth, building wealth, and then transferring wealth down the road. If they have surplus in their corporations, shareholders who are looking to kind of reduce their corporate taxes, I haven't met one that isn't interested in doing that. If they have a recurring or a future tax liability that's been identified, very few business owners, if they haven't dealt with me and my team as a financial planning specialization, they're typically not seeing that type of forecasting done from their accounting firm. So we're happy to do that work, share that analysis with accountant firms, and we ask for the business owner to be open to paying their billable hourly rate for their accountant so that we can collaborate. And as a result of that approach, we are closing and doing quite a bit of business these days as everybody is really upset about the tax on growth and tax on death issue that they have facing them because of the rules that were implemented.
Wow.
Thank you so much, Uriah. That was a great overview, and obviously there's lots of little pieces to unpack with this whole thing that really need to be done on an individual and a consultative basis. But in these unprecedented times with, governments having to support individuals, around the world, and just, this part of our economy is, they're huge contributors to our overall economy in terms of the people they employ, et cetera. So anything we can do to help them, strengthen their financial position in these times, given the changes that have been made, I think is super, super important to help this targeted group of our community and our economy. So just looking for ways to help protect their families' wealth and